before we can actually do financial statements, we have to go through an adjustment process. And the reason that we have to adjust, number one, we do this periodically. So these are not things that you do on a daily basis. And because of that, that's one reason that we need to have some adjusting entries. Some accounts are items that need to be adjusted because you've either used or provided those items in the course of business, but you have not yet reflected that in your accounting. Or there are some items that have not yet been recorded. So for those reasons, we need to have adjusting entries, especially before we prepare our financial statements. Otherwise, our numbers will not be correct. So there are two main areas of adjusting entries. You can have deferrals or accruals. If you have a deferral, that means that you've already had cash involved somehow, but at that point in time, I'll give you some examples of these in a minute, but you did not yet have an expense or a revenue that was incurred or earned at the time, but cash had changed hands. So you got something recorded on your books, and now you need to actually adjust it so that it reflects that expense or related revenue. Accruals are the opposite. These are things that, number one, are not yet recorded, and number two, have nothing to do yet with cash, but you have incurred them or earned them, so you need to record them. Again, I'm going to give you some specific examples for both of these categories, but these are your broad two categories of adjusting entries. Under deferrals, you have two types. In general, you've got four areas of adjusting entries. The first two are deferrals, and the second two that we'll talk about are accruals. And there's also a specialized type, depreciation. And we'll get into a lot more with depreciation in your chapter dealing with fixed assets or property, plant, equipment, same thing. So we'll talk a lot more about it. I'll briefly touch on it at the end though. But first let's talk about these two deferrals I have listed, prepaid expenses and unearned revenues. With both of these, cash has changed hands, but we have not yet incurred an expense or earned the related revenue. So two examples I'll give you. One would be supplies. Let's say that you went and purchased supplies at the office supply store, right? Bought paper and pens and pencils and toner and staples and paper clips, anything and everything that we need. All right, let's say that you buy $500 worth. So let's go ahead and do an example with this one. So let's say you've got $500 worth of supplies. Okay, well, when you first purchased them, what entry would you make? You bought them for cash. Okay, so we purchased supplies. That's an asset. And we're going to increase the asset, so we need to debit it by $500. And then we paid cash. That decreased cash, which is an asset, so we'll credit that. Okay, so there's the entry we made originally. But aren't we going to use those supplies over time? Right now they're not used. They're an asset. We own that $500. But let's say at the end of the month, we go in the supply closet and we look and we see, yeah, we've used some items. We're not going to make a daily entry for each piece of paper that we use or each eraser or each staple. Okay, that would just be not worth our time, right? Not cost beneficial. So we go in periodically and see what's left. So let's say that we go and count up, and now we've got $300 left in the supply cabinet at the end of the month. Okay? At end of month. Alright? So, what I want to do now is make the adjusting entry to reflect the supplies that have been used. Okay? To begin with, that supply account is a prepaid expense. It's not an expense yet, but it will become an expense as it is used. Okay, so now supplies should no longer say $500. If we leave it that way, we've overstated the account. It's not $500 anymore because we really know there's literally only $300 left there. So we need to decrease it by $200. And where does the other side of this equation go? Well, we said that prepaid expenses will become expenses. They start out as assets, but they go to an expense. We're going to put this in an account called supplies expense. That's an expense account. We're increasing it, and we're increasing it for how much? There's $300 left. We started with 500, so we have used 200. That's the expense I need to recognize. So we debit that account for 200, and we're going to decrease the supplies account by 200. It's an asset, so we credit it. That's the adjusting entry we make for a prepaid expense. You could do the same thing with something like prepaid insurance. If you paid an insurance policy up front for, say, 6 months, and you've used a month of it or 2 months, same kind of process. You want to find out how much has expired or been used, and that's what you want to increase that expense account by. Unearned revenues is another area for deferrals. This would be, for instance, a magazine company, and they sell subscriptions. Well, when they sell the subscription, they get money for it, but have they actually provided any magazines yet? Not yet. So now they owe someone those magazines. So let's say someone pays for a 12-month subscription up front. It's a monthly subscription. Well, when they pay us, what we're going to do is record an unearned revenue. Let's see if I've got enough space on this sheet for that. Okay, so we get cash. It's going to increase cash. And let's say it's for $1,200. Because that's just easy. Well, that would be a lot for a subscription one. Hang on. Let's do this in different. Let's say it's $120. Okay, so we got $120 for a 12-month subscription. What do we credit? We haven't actually earned the money yet because we have not provided them with any magazines. So we're going to use an account called Unearned Revenue. Keep it very generic right now. This is actually a liability account because we owe someone something. We owe that customer magazines. So this is a liability that we're increasing. So we're going to credit it for $120. So we've already gotten the cash, but we have not yet earned the revenue. It's a unearned revenue. And we have literally called the account that. You could have said unearned magazine subscriptions if you wanted to. It's up to you. So now it's been a month and we're making our adjusting entries. Well, we've sent them one magazine. Alright? So $120 is now not the amount that has unearned. Alright, so we need to reduce that account. So we need to debit that account because remember it's a liability. We reduce liabilities with a debit for $10 because that is a 1/12 of what we got in, and that was for 12 different months, 12 subscriptions. And we credit what? We don't owe them it, and now we have actually earned it. So let's just call this, it was magazine subscription. So we'll put subscription. Oh, I can't write. Revenue for $10. Credit that. That's a revenue account. We're increasing it. Okay? Alright, let's go to the other category, accruals. Now, accruals are something that are not yet recorded, but they do and they do not involve any cash also. Okay? So something like, let's start with the first one, accrued revenues and accrued expenses. We have both sides. An accrued revenue would be, I'm an accountant and I've done your taxes. You came in, I did them, I've given them to you, but you have not yet paid me for them. But I really did provide you with my service. So I have earned a revenue. I just don't have the cash yet, okay? But I need to go ahead and record the revenue now. So to accrue the revenue recorded on our books, let's just say that we don't have cash. So the other side of this is going to be what? I know I've got a revenue account involved. I don't have cash, but it sounds like you owe me money, so that sounds like accounts receivable. That's an asset. We're going to increase that account, and let's say it was for $50. So you owe me $50 now, and I reflect that on my financial statements. And let's just put fees earned down here. Fees earned. It's a revenue. We credit it or increase it for $50. Now I have accrued the revenue. You can have the same thing on the expense side. A frequent or common example for accrued expenses would be with payroll. Let's say you run a payroll and you pay on Fridays, but your month ends on a Wednesday. But you do a 5-day pay period and pay on the same day, that last day on Friday. Well, to do that, you'd need to calculate how many days are in your current accounting period, those 3 days, and then record that as an accrued expense because you're going to pay them on Friday, but they worked at least those 3 days this year. So that would look something like, say we use wage expense as our expense account there. And let's say it came up to I don't know, $2,500. We increase that account. That's the amount of wages that have accrued. We're not going to pay them yet, so we don't credit cash. We're going to credit wages payable, some type of a liability to show that I owe that money, but I have not yet paid it. That's an accrued expense, so we credit or increase that account. Notice that with all of your adjusting entries, you have one income statement account affected and one balance sheet account affected. Now, after you get done with all of these journal entries, or adjusting entries, specialized type of journal entry, you're going to post them, update the accounts. You're going to run an adjusted trial balance. The only difference between an unadjusted trial balance and an adjusted, they look the same. It's just your numbers will be different because you have made adjusting entries in between those two. Then you're ready to make up your financial statements. Now let me show you one other adjusting entry that you'll see, and that's that special one that I referred to called depreciation. Depreciation is where we take into account that we've purchased assets and they're going to reduce in usefulness over time for physical wear and tear, but also for functional decreases. For instance, computers. You get them the first day. If you still have them, say 3 years later, they don't run as efficiently as they once did. So it's to account for both of those, and it's to take the cost of it and turn it into an expense over time. So we're not going to get into how we get the numbers for this quite yet. We'll do that in a later chapter, but depreciation, the entry for that, we're going to use a new expense account called depreciation expense. And let's say it's for $1,100. We're going to increase that account by $1,100. And then the account that goes against, let's say this was for equipment. We're not going to credit or decrease the equipment account because I want to keep the cost of the equipment in its account, the historic cost. So what we do is we actually make up a separate account, another one called accumulated depreciation. It's an account for us to accumulate or add all of the previous year's depreciation and keep up with the sum or the total in there. And what we'll do on the balance sheet is take that historic cost of equipment, and then we'll have this accumulated depreciation account, and we can take the difference between the two to tell me what book value is. Book value, I'll put this down here, book value equals cost minus accumulated depreciation. Alright, so I'm going to shortcut it with that to save space on the screen. So we've got accumulated depreciation, and we credit it for $1,100. Accumulated depreciation is actually an asset account, but it is a contra asset. So it's contrary to the norm. So where assets normally have a debit balance and are increased by debits, accumulated depreciation is a contra asset. So it holds a credit balance and is increased by credits. So, if you had the equipment cost, I could have the total in accumulated depreciation for each year, and the difference between those again will give me the book value of that asset. That does not mean that's the fair market value. It does not mean that's how much I could get for it if I wanted to sell it. But that is just an accounting figure that we refer to called book value.